right, what's up, everybody? It's Cowboy. Yep, I am here. 8:30 a.m. EST. Let the show begin. Sorry about the throat clearing. Just had a kind of a frog in my throat. We had a change in the weather. Finally cooling down a bit, and so I let the windows open last night just for a short time, just to let some cool air into the house, and I feel like I'm kind of paying for it now. So if I sound a little froggy, well, then hey man, call me Kermit. It is what it is. So yeah, we just had some data come out. Let's get into it. It shares the screen. Usually I'm trying to have that done before we start, but oh well. All right. So let's take the look. PPI came out this morning. That's like CPI's cousin on the producer side, CPI being the consumer price index measure of inflation. Today, the producer price index, right? And they both were a little bit hot. It was interesting here. The reason that the talks of interest rates have been a thing, right? Like the reason that they're talking about either hiking or cutting the interest rate has to do with managing inflation. And I know we go over this like every time, but there might be some new people watching the show, or just a reminder, it's always good to go back to basics. So the higher the rate, the lower inflation tends to be, because money becomes expensive. And when money becomes expensive, it's harder to borrow. When it's harder to borrow, it's harder to finance everything, because everything is debt. All money, every single 100% of all fiat money, which is the vast majority of money that is used. I mean, like, the vast majority. It's like almost all fiat. Virtually all money is fiat. And especially when it comes to markets, right? You're not buying stocks for gold. You're taking fiat money and buying stocks, and that's really what matters here. And when that money becomes expensive, then it's going to be hard to finance the market. And the market is 100% financed. I mean, I 110% financed. All the stocks, it's all based on borrowed money. With that being the case, when inflation continues to rise, then the Fed's mandate, the Fed's job, is to make sure that inflation stays under control. And they have basically two tools. And the one tool we're going to talk about today is going to be interest rates. So they could just hike interest rates to keep inflation from getting out of control. And during the pandemic, there were trillions that were just shoved into the economy. And because of that, that just increased the amount of money that was in the economy. It didn't increase the amount of wealth. It didn't increase the amount of actual goods. All it did was put more money into the economy. And when you have more money chasing the same amount of goods, you have inflation. And so we're seeing here that both of the inflation metrics were slightly above estimate. It's not a very big, overshoot. The estimate itself was not a very big undershoot. Last week, it came in cool. This month, it came in hot. Now, of course, there is a lot of very valid consideration that these numbers are not exactly correct. We have a lot of numbers, especially in recent years, and especially this year, being revised a little bit later. You'll have a revision that happens like a week or a month or 6 or 8 months later that really, really throws the market into a tizzy. It's like, oh, well, we got it wrong. And so I don't understand why they're releasing data before they have all the data, but I could guess why, but let's not go there. Let's not talk about how everything is a scam. Let's just talk about how the market works, right? So in this case, this a little bit higher of an inflation, higher than estimated. These numbers coming up a little hot. What that means is that they're not necessarily going to be as interested in cutting the rates. And there was supposed to be a rate cut. Or at least, I don't want to say supposed to be. There were a lot of people who thought there would be a rate cut coming up next week in September. And typically, the Federal Open Market Committee that discusses this, that makes that decision, that tends to happen in September. Forgive me. It tends to happen about every month. It's not every month. I think it's technically, it used to be like 8 months a year. Whatever it is, though, it's basically once a month, right? And it's next week in this case. And a lot of people were expecting a possible hike. But the reality is that these metrics today and yesterday's CPI came in just a little bit hot. And if that's the case, they may not be interested in cutting rates. And if that's the case, then the market might be interested in kind of like staying where it is. And that would fit. And let's go into the charts And, we'll take a look at the actual stock market, because typically running into an election, at least for the last few elections, the like the SP 500, the stocks, all that happened sideways going into the election. Now, yesterday at the beginning of the day, there was a pretty strong move down, right? And we're looking at the SP 500. We're actually looking at the E-mini. And price, let's get out of the daily. We'll go down and look at like the 3-hour chart. Price actually moved down in the beginning of the day, and Bitcoin and everything else took a tumble, and then it popped up nicely. Everything popped up. Bitcoin, everything recovered. Huge, massive swing. 700 point plus swing yesterday. So price came down and then got pushed back up. I'm willing to believe it was the plunge protection team, basically, a group of who knows who, that it's their job to keep the market from falling, basically. And so, with that being the case, right, we have to consider that, we're just looking at machinations. We're looking at the market being held up, and we're looking at a sideways market going into the election, most likely, and only because that's what's happened before, right? Now, just because something happened before doesn't mean that it's going to happen again. We don't want to say it's absolutely the case, but typically, what do they say? History doesn't always repeat itself, but it often rhymes. And typically that's just how it is. You get these sideways into the election type situations, and it just is what it is. So, give me just 1 second. I'm going to take a quick trade here. I'm going to go short on the JPY. I'll share that trade here in a minute. Let's see here. Okay. I was kind of waiting for this data to come out, and I saw a nice trade opportunity, and I wanted to take it. Okay, what is this on? Ichabod. All right. So let's take a quick look at a trade I just took here. And none of this is for investment. It is investment advice, by the way. If I show you a trade, it's for educational purposes. You're not supposed to be following my trades, but it's a free, it's a free country or whatever. So, I mean, I can't tell you what not to do. But I can tell you what I'm saying is not investment advice, right? So let me put some notation on this chart here, so everybody can just see for educational purposes what I'm doing. Give me 1 second. There we go. Just throwing up my measurements here. There we are. Okay, so just take a little continuation trade. I mean, this is a clear downtrend. This is a kind of a freebie out there where, now that the data is out, right? I don't think we have any other major data this week. Let's double check. On the euro we do, but that's the euro, right? So this is a USD JPY trade, and we have no major. We had the unemployment data came out too, which was pretty much a nothing burger, right? So for the USD and for the JPY, there's not a lot of data coming out. So I feel comfortable taking this trade. So what am I doing with this trade? Why am I in this trade right now? And the conclusion to this last conversation is that sideways movement into an election is pretty typical. So we may just see the market kind of go sideways for the rest of the let me send that link. Yeah, typical. That's just, markets just kind of not doing a whole lot, being held up. Look, one thing to know about rate cuts is that typically after a rate cut, at least after a couple of rate cuts, if the market thinks that the cutting cycle is in, right, then the market actually contracts for a short time. It's not a permanent thing. It's not it doesn't necessarily mean we're going into like a hard bear market, but it could be like 6 months that the market goes down. So they may be holding off on cuts just for that reason. So back to the JPY trade here. Price is in a downtrend. We've talked a lot about what's going on with the USD JPY, right? And the whole, Japan carry trade. I mean, we've done show after show on it. I'm not going to go repeat that, but this right here, what we're looking at is a very clear downtrend. And this is going back to July. So the Japanese changed their stance, and the Bank of Japan, that is. So basically what they were doing is they were saying, okay, we're not going to be the world's like stock market liquidity solution anymore. Because what would happen is the Japanese would the Bank of Japan, I should say, we're doing it just a big carry trade, and they would print extremely cheap, very low rate bonds, and then they would use those bonds to purchase other assets around the world, and then other assets would gather those bonds. Well, now what's going to happen is they're hiking their rates, and they did it 2 times in a row for the first time in decades. And so they're going to start protecting their currency. And if you look back, this is the 3 hours. So if I were to go to a higher time frame, and like I said, I was just demonstrating a downtrend right there, right? But if you go to say like a monthly chart, right, to very high time frame, you'll see that the Japanese yen has been doing nothing but going down, and that's why this chart goes up. I know it's kind of confusing, but going back to 2012, the Japanese yen has been cut in basically half, less than that, as compared to the dollar, because the dollar keeps going up against the yen, right? And so because of that dynamic, the Japanese yen's gotten weaker and weaker. Well, the Bank of Japan no longer is doing that. They're going to hike rates, and that's in an environment where the U.S. may be cutting rates soon. So the move down here has been pretty powerful, and that went back to June, right? And then of course we had where about a month ago you had the official stance that they're going to stop the carry trade, and the whole market kind of freaked out. And so, long story short, though, there has been a strong downtrend, and I don't expect that to stop right now. I don't expect that to stop. And that was on a higher time frame that I drew, but we were also in a lower time frame downtrend. So we're in a downtrend within a downtrend. And anytime I'm in a downtrend, what I like to do is sell the rallies, right? So price action is always going to be king. And I love my indicators, and I use the heck out of them. But when I see such an obvious price action play where, delete that, where you're in a downtrend and a downtrend within a downtrend, right? So, here's the clear moves down. And then here, even on a local aspect, you have this downtrend right here and a clear rejection, right? In a bearish environment, I'm going to sell the rallies. And so we just had a little mini rally, and my indicators all tell me that this is also a great time to sell. So you got price action and indicators. So what I've done is I've used, just for kind of a low time frame scenario. When I say low time frame, I should say mid time frame. I'm going to use my Fibonacci's, right, to take a look at what the targets might be. But before I get too far in Fibonacci's, I got to look at structure. And we do have a concern with structure right here, going back to December 2023. So I wouldn't want to necessarily, like, as price crosses or comes to this structure from December, I would at least want my risk to be off this trade. At least want the risk to be. And what does that mean? That means I've taken my stop loss and I've put it to my entry. That means if the trade goes against me, I'm not going to lose any money. And in fact, I might have already made some. So in this case, I'm going to have an initial target that's above this local structure, right? And as soon as price hits that, I'm either going to put my stop to entry or I might take some profit. Stop will go to entry for sure. But then I'm going to have, again, I'm going to have some profit being taken off so I can grab some money, right? So I'm going to label that take profit 1. And that's at 149.71, 140.971, that is. All right. And then, this structure right here, let's relabel that. Hold on a second. So TP1 and stop to entry. And then, of course, we have our TP2, and I'll put my actual take profit there. But it may not make it there because we have this old high time frame, strong support right there. So there's a really good chance that price may not go all the way there. We'll mark our stop loss so we can be alerted. And now we're good to go on this trade. So we'll see how it goes. Again, the The metrics point towards this being a good trade, and I've taken that trade, and that's that. All right, so now we've talked about the stock market. We've even done a whole trade, and we're about 5 minutes over. So I hope that this was fun. Got a little bit of a freebie here. Come on over to algofactory.tech. Zap the QR code in the top right-hand corner. And if you zap that, you're going to be taken to our website, which is algofactory.tech. And you can sign up there if you're interested. We help people become traders. We help people learn how to create their own trading method, right? And this is the secret in trading. People think that they're going to take somebody else's method and be successful, and probability is actually against you because you have not tested that method. You did not create that method. That method does not have your personality imbued upon it, right? Because you will imbue your personality upon your method. And that's extremely important in trading. Psychological aspect of trading is more important than anybody knows, with the exception of a few traders who learn. And we teach you all about that as well at Algo Factory. So come on over, algofactory.tech, trade your job, upgrade your life.
Join us or die.